Dzień dobry Państwu, witamy.
Good morning, ladies and gentlemen. We would like to welcome you very cordially. Ladies and gentlemen, at our today's conference, we will present to you the financial results for 9 months of this year. And for 2017, I would like to welcome you very cordially. The hosts of our conference are obviously representatives of the management board, Mateusz Lukonza, president of the LOTOS Group, Robert Sobków, CFO, Jarosław Kabula, responsible for production and trade. At your disposal, we also have other representatives of the company, Wojciech Zegteler, Investor Relationship Office, and I am the one pleased to give you a warm welcome as the press spokesman of the LOTOS Group. Mr. President, the floor is yours. I am very pleased to welcome you, ladies and gentlemen. After the 9 months of 2018, I can share very good news about the LOTOS Group. I will give you the general background, including key information about the company, the extraction segment, and then I will give the floor to Mr. Kabula, who will tell us more about production and trade, and at the end, Mr. Sobków will tell us more about the financial results achieved by the group. The third quarter 2018 was a very good quarter for the LOTOS Group. On one hand, some things that we had been planning for a long time actually occurred. The dividend was paid, 185 million. And on the other hand, our production fared very well, and all our trading setting that allows us to place our products in the market functioned very well. LIFO represented 8% growth from the previous quarter. Although, and that I will return to this in a moment, although we had a certain planned stoppage in Sleipner in Norway, which of course affected our results. The refinery was fully utilized, and we took advantage of the market conditions, which allowed us to place our products in the Polish market very efficiently. Net debt to EBITDA LIFO ratio is improving. It is now at 0.6, and the strategy we're talking about the upper limit at 1.5, which shows that the plan which we published in 2016 and which said that we wanted to be safe, we wanted to develop in a stable manner, is functioning in practice. We are stable financially and ready for subsequent investment activities, and we have high operating cash flow at 1.3 billion PLN, which also shows how healthy, how sound the company is. A few more numbers for comparison. Between this year's 9 months with the results in the same period in the previous 2 years. As you can see, the stable is stable. The LIFO ratio for 2018, no, I think I'm showing the wrong slide. 880 million LIFO EBITDA versus 821, and very high processing at the refinery. Debt to EBITDA ratio also very good. In a moment, I will give you more details about the slight decrease on this last point. 9 months of 2018, 2.25 billion EBITDA LIFO, which is basically equal to what we recorded last year, and net debt 1.9 billion PLN, net debt ratio at 0.6. Here in slide 7, the numbers probably give the best picture of the situation in the company after the 9 months this year. The results are very close to what we had in 2017. Basically, they are equal to what occurred in 2017. And you have to bear in mind the developments last year and what happened in the third quarter this year. There were some upheavals this year, so in total the results were very good. Processing of oil, very good, beyond comparison higher than last year. Last year we also had this refurbishment downtime, but also it was higher than in 2016. Good operating cash flows and daily extraction of hydrocarbons and 2.4 thousand barrels per day, which is the expected level and consistent with our strategic assumptions. Now, what our macroeconomic environment was like. On the left-hand side of the slide, you can see the environment which affects our upstream. Higher quotations of oil and gas than in our strategic assumptions, but on the other hand, the product cracks, that is, our results in terms of products that we place in the market. Slightly lower cracks for petrol and diesel. For us, diesel is basically of key importance, which also shows that the results are good and sustained, which indicates balance between extraction and refinery business. Those two legs of our activity support each other. Exchange rates, as you can see, a slight consolidation, and consumption of diesel and petrol is very good, strong and growing, which is joyous news to us because that proves that the market is healthy, and the GDP growth, which is high, and that is a fundamental driver of our product development. Now a historical picture of how quotations of oil and gas and of product cracks changed. You can see certain trends which of course affect our daily operations. Extraction, that is always interesting. So let me begin with a brief comment about our licenses and active sites, P8 and P3, then in Norway and then in Lithuania, Geonafta. Here probably an important note for you, even before we look at the financial results. In one of the licenses, in Sniper license, there was a downtime of almost 1 month, from the end of August until almost the end of September. Apart from the planned maintenance work, also some preparatory work was performed to prepare the infrastructure to connect a new deposit, Kutgard, where we also have a license. So it was preparation for future extraction. And then quarterly breakdown of extraction, slightly lower, and the main factor driving this decrease was this monthly stoppage on Sniper license, which represents a significant share in our extraction portfolio. And extraction for 9 months, 5.6 million equivalent of barrels. 2P reserves, you can see natural utilization in Poland and Lithuania, but also Polish classification B3 deposit, where we managed to extend the license, so we will be able to operate this deposit for a longer time, meaning that our reserves are upheld and maintained within the corridor that we defined in our strategic assumptions. Quarterly operating results better than in the third quarter 2017. EBITDA after 3 quarters, almost 200 million PLN. Clean EBIT after 3 quarters, 164 versus 99 in the third quarter 2017. So on the one hand, a certain reduction of extraction related to maintenance of traffic on one of our major licenses, but on the other hand, very good macroeconomic conditions allowed us to generate a high economic value of the company. And after 9 months, then comparison, a symbolic but still growth in EBITDA, 1% up. We can see stable functioning of the extraction segment in the company. And of course, we are preparing to launch subsequent projects with which you are already familiar. Just to remind you, Kutgard, Frigana Delta, B8 and Meto. These are the projects we are working on at the moment. I would like to give the floor now to my colleague. Let's move on to production and trade. As regards sales volumes for our key products, here you can see quarter-to-quarter growth, or third quarter 2018 versus third quarter 2017, 2.3%, which shows that the Polish market is still growing in terms of sales. And we have to remember that we had a very high base in the third quarter 2017. If we look at operating results, to a large extent they are driven by quotations and by cracks. Here we depend very much on macroeconomic conditions. And if we compare the third quarter 2018 with the second quarter this year, you can see a very clear growth in this result. And compared with the third quarter 2017, we remain on a very similar level in terms of EBITDA in LIFO methodology. If we look at 9 months of 2018, we will see previously you could see processing of oil that in the third quarter was record high. As a result, we managed to maintain very good EBITDA in 2018 in spite of somewhat lower macroeconomic conditions as represented by model refinery margin. And that is illustrated in this graph. Model margin results on average for 2018 are slightly below 2017. The fact that we process a lot of oil and that we sell a lot of products means that the result, operating results of the production and trade segment was maintained at the level of 2017. Thank you very much. And that brings us to consolidated financial results. On a financial front, we have just good news. As has already been said, LIFO EBITDA for 9 months, almost 2,250 million, and last year that was less than 50 million more. And EBITDA for just the third quarter also stands at almost 50 million under the last year's result. But we operated under conditions of rapidly growing prices of oil. There is no full correlation between oil price and downstream results, but there is some dependence here. In upstream, it is almost full. When oil prices go up, upstream gains suddenly, but in downstream also there is a certain correlation, but in this case it is negative. In this environment we function throughout the third quarter and we achieved results comparable with ones achieved last year. And what is more, let's skip 2 slides. During this time, we recorded not just high profitability, but also two other factors that contributed to our cash flows and the results that we generated at the end. At the end of the third quarter, we have cash and cash equivalents at more than 2 billion PLN. That is the number in our consolidated balance sheet. This comes from the high profitability, but also from the reduction of stock of inventories. In the third quarter, we have a sudden growth in cash flow on operations. We have financial result plus the decrease of inventories. These were two main factors contributing to this 1.3 billion. This result is not only better than what we had in the second quarter, but it is also better than what we had in the third quarter last year, because then we were at 1,245 million, and now we operated in a more difficult environment, but we managed to generate better cash results. If we compare this cash at operating level with our capital expenditures, we can see that there is a reduction. In the 9 months 2018, there was a drop from almost 1 billion to more than 600 million. We operate in an environment where we bring about a situation where capital expenditures are financed from our current cash generated in the company. Also, repayment of loans, repayment of liabilities, because we are a company that has loans and we have installments due to repay. We are repaying all those installments from our own funds. We do not roll them on, but if the maturity date falls, we as the LOTOS Group repay those installments from our own funds. And this last slide shows our consolidated financial results in the context of debt ratios. The slide shows a sudden drop of all three debt ratios that are shown here. Net debt, please note, in 2018 was almost 5 billion, and now it decreases to less than 2 billion. We achieved that with our own cash that was generated in the company. This is something very important that needs to be stressed. Also, net debt to EBITDA LIFO also reached a relatively low level, 0.6. That is the level that we also assumed for this year. And we still have 3 months ahead of us. So we expect this ratio to improve in the following quarter. And that ratio from 56% through 23% last year now is at 16%, which also shows a certain level of financial potential that we have in a situation when we decide to pursue pro-development investments. We have major potential in financing such investments. So first, we finance our investments from our own cash, we repay all our loan liabilities from our own cash, and we created major potential to finance our capital expenditures. Thank you. Thank you very much. Ladies and gentlemen, now is the time to ask questions. If there are no questions, thank you very much. Of course, you will have a chance to talk to members of the Management Board of LOTOS Group unofficially. Thank you very much, and we invite you to those informal conversations with the representatives of LOTOS Group. Thank you very much for attending this conference. We have shown that we are a strong and stable company and a very well managed one. Thank you once again.